from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Caroline Hyde in New York for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, Musk walks and Twitter it tanks. We'll bring you the latest on the legal battle ahead and what the future of the $44 billion Twitter deal actually looks like. Plus, a slash in valuation for one of Europe's most high-profile startups, Klarna, being valued now at just $6.7 billion, down from $45.6 billion just 1 year ago. We talked to an investor in the company. And a prime-time shopping event. Amazon kicking off its two-day shopping extravaganza on Tuesday. How Prime Day could help Amazon's third-quarter online sales gain. We're going to be getting to all of that in but a moment. But first, let's get a look in on those markets. And mega-cap tech, well, they were down on this Monday, snapping a hot streak for the sector in the last week. Bloomberg's Ed Ludlow, well, you're going to be pushing us ahead to all-important earnings, but some risk aversion today.
Yeah, I would say risk off is the buzz phrase of Monday's session. Look at the NASDAQ 100, biggest drop in around 2 weeks. We're off the back of 5 straight days of gains for the NASDAQ 100, which was its best winning streak since November. You look at some of the areas of pain, semiconductors, the SOX down 2.5%, one of the underperformers, at a time where yields are pulling back again below 3%. Bitcoin kind of caught up in this risk-off sentiment. But there is a bit of a pattern emerging, I suppose. You come with me inside Bloomberg Terminal and look at this chart. We've seen in recent weeks the NASDAQ 100 make a weekly gain and then pull back, the rally kind of losing momentum. Then we have a few down weeks, then we have an up week. There's no real staying power, and I think you're right, Caroline, that what I'm hearing in the market this Monday is we're waiting for earnings season to get a real lens into the world. How worried are we about inflation and recession fears, let alone the impact of Fed and the rates? And as always, really big corporate stories pushing the agenda. If you come with me back to the studio and look at kind of the stocks on the move, it was the mega caps like your Apples pulling down the index from a points mover perspective, but Rivian down 6.5%. Bloomberg scoop that the company plans to cut 5% of its workforce. You and I are going to talk about that later in the show. The big story, I'm going to have my go at it. Twitter down 11% after Musk filed to walk away from that merger agreement. The breaking news after market close is that the law firm representing Twitter says that the company has done nothing wrong. I know you're about to get into that, but also interesting to look at Tesla. The first higher early in Monday's session, then down 6.5% at the close. The investors looking at what this all means in the bigger scheme of things. What is Elon Musk going to do? Is he going to carry on? What does it mean for his Tesla stake? Will he have to sell it down still? More questions than answers, which often, in my experience, Caroline, is the way when you're talking about Elon Musk.
And I'm pleased to say that we've got more answers coming from you on our questions about your scoop, Ed Ludlow, on the Rivian news. Meanwhile, let's get back to the scene being set for a disruptive legal battle over the future of Twitter. Shares of the social media platform falling after Elon Musk walked away from his $44 billion deal to buy the company. Musk alleges, that Twitter misrepresented user data. Twitter plans to sue Musk to close the transaction. Bloomberg's Kurt Wagner joins us. And just ahead of our conversation, Kurt, of course, we understand from a lawyer for Twitter, and it is always the lawyers that win in this, it would be said. Twitter's lawyer saying that Musk's termination is invalid and wrongful, and he says that Twitter has breached no obligations. Where are you at with this?
Yeah, we're getting to the fun part of the deal where all the lawyers are just going to start sending each other letters back and forth, and we're going to have to parse through all this legalese. But you're right. Now it's Twitter's turn, right? On Friday, we were talking, Caroline, you and I were live on air when we were reading, this letter from Elon Musk's lawyers basically saying, hey, Twitter, you violated this agreement. Now Twitter has filed its response and is basically saying the opposite. We have upheld our version of the agreement or our part of the agreement, and it's you who has been misleading or who has violated, right? And so we're clearly headed to a court here, and both sides are going to get to argue their case. But at least for right now, the lawyers are starting to put their respective arguments out into the universe.
And what is some of the theories being held here as to how it could turn out, who could win out? It's not just going to be a $1 billion termination fee, it feels.
No, I would be shocked if that's the ultimate result. I would imagine that we're going to end up somewhere in the middle, right? I think there's two kind of dramatic outcomes that could come from this legal battle. The one is actually what you just said, that a court rules in favor of Elon Musk and that he pays termination fee and walks away. The other is that they rule in favor of Twitter and they force Elon Musk to spend $44 billion to buy a company he doesn't want to buy. Now, alternatively, I think these two sides could settle somewhere in the middle. That to me seems like the most likely scenario, right? But in that case, there's infinite number of outcomes here, so we don't know exactly where they're going to end up.
Nothing like infinite amount of outcomes to pass. Kurt Wagner, again, thank you so much for all your expertise on that Friday and for expertise again today as we continue to follow this pretty torrid story. Let's get more analysis for you. Let's bring in Mark Mahaney of Evercore, who covers the company. And, well, as we're saying, an infinite amount of outcomes here, Mark, but from a fundamental basis, without the $44 billion offer, what is Twitter worth?
It's probably not too far off from where it would trade if the deal was decided tomorrow. It was off, probably come off a couple of percent, but there's some markers in the market. You can look at the multiples that Pinterest and Snapchat trade at. And, maybe there's a little bit of downside to the kind of high 20s, $30 range, something like that. But it's not much more dramatic than that. And the difference here is, by the way, we kind of forgotten this and all this, the noise, is that Twitter's a good asset. It generated $5 billion in advertising dollars last year. Advertisers were obviously cognizant of and willing to tolerate the bot issue. And the company generated positive free cash flow margins for several years, prior to the COVID crisis. So it's a business that's at, reasonable scale, decent growth. It's underperformed major peers like Google and Facebook, but those were always unfair comparisons. It's a decent asset. Recently, it's probably been somewhat impaired by all the uncertainty over this deal. And then going forwards, it's probably somewhat impaired by the recession that's taking out growth from almost all internet ad assets.
Does it become impaired by advertisers walking away because of bots, as it seems that currently Elon Musk is trying to argue?
I don't know, Caroline, it's possible. I've run surveys on Twitter for 10 years, advertiser surveys on Twitter for almost 10 years. It's never come up as an issue. I've never actually had a channel check or a discussion with an advertiser that said, I can buy ads on Facebook, but I can't do it on Twitter because of the bots issue. I've never heard that. That there are bots, that there are click farms in social media. I think that's well understood. It's part of it's part of the peril of these industries and these companies, and Twitter and Pinterest and Google and Facebook have always had to fight back against these bot farms. It's just part of doing business. People run bots for political reasons. They run them for commercial reasons, but it's always been a factor. I don't think it's been an issue for advertisers over the last couple of years. I think that $5 billion in ad revenue that Twitter got last year, they earned it. And I think advertisers weren't put off by the fact that there were bots on the platform.
Has there been any upside to this whole fiasco for Twitter?
I'm struggling, Caroline. I think there's been no upside. So all you've done is created a lot of dysfunction within the company. They've lost some of their top employees. There's probably been some demoralization of employees because, Musk has come out and said that there were too many people working there. How would you feel if somebody who was going to buy your company started off by saying there are too many employees at the company? So I just think that's what's happened is very unfortunate. And I thought Musk had a lot of interesting ideas of ways to improve Twitter. And maybe this will all come out and maybe we will get some sort of resolution at a reduced deal size. But my guess is that the worst case scenario is going to come through, which is that this is going to go through the courts for some time. There'll be some sort of breakup fee, and then Twitter's going to have to rebuild a little bit. And that's probably going to be a year from now. And it's very unfortunate, I think, what's transpired here over the last couple of months for investors as a whole.
And just put the sort of, mind math for us out there. If indeed Elon Musk is forced to buy it, how damaging is that?
Caroline, these are just really hard questions to answer. They're uncharted waters. I can't imagine it'd be good for Twitter to be owned by somebody who has no interest in owning the asset. Although I'm sure that's happened in media landscape. So it gets. I mean, what he wants to do is take it private. So and he was very clear from the beginning. His intentions were not commercial. idealistic, if you will, or ideological is the wrong word, but he had vision reasons for buying the company. This was about vision, about an asset that he really cared deeply and passionately about, and he wanted to see it improved ways that he thought he could improve the asset. And I thought he had some interesting ideas. I thought he was going to get into this morass. It's very difficult, these issues about what should be moderated and what shouldn't, and whether anything should be moderated. And it really requires a lot of adults in the room, I think, to solve those kind of problems. And I think Twitter had some of those people, by the way, in the past. But anyway, I thought Musk was going to bring a fresh perspective to the company that may have actually helped the asset, something that's well known and used by so many people around the world. It's just unfortunate how this is all wound up where it is today. I don't think anybody looks good coming out of this.
Well said. And indeed, we think you come out looking good to give us your expertise over there at Evercore. We thank you, Mark Mahaney, really trying to find the fundamentals in what is, in general, a non-fundamental story at the moment. Meanwhile, coming up, buy now, pay later, darling Klarna sees its valuation absolutely slashed in the latest funding round. We'll discuss the dramatic reversal with Andrea Wolny of Manhattan Ventures Partners. This is Bloomberg. Bit of a dramatic reversal for one of Europe's most high-profile startups, Klarna Bank. Valuation being slashed to just $6.7 billion in its latest funding round, we understand. That's down from, at one point, more than $45 billion in June 2021. The Swedish buy now, pay later giant has been burning through hundreds of millions of dollars, of course, as a startup. And joining us to discuss where next and how we continue to see talent sort of recompensed in this market, Andrea Wolny of Manhattan Venture Partners. Andrea, it's really great to have you on. And of course, Klarna, one of your numerous members of your portfolio. And I'm interested as to what happens in these environments, how painful it is for the executives leading the business and the people who've invested.
Yeah, so thanks so much for having me, Caroline. So I will say that at Manhattan Venture Partners, where we invest in growth and late stage companies, much like Klarna, while they're really hitting the peak trajectory of their business, is that we still believe that extraordinary companies backed by the best investors will deliver these types of outsized returns. And so even though Klarna has seen their valuation compressed, we believe in their long-term prospects very much so. And I think that they're deploying a number of strategies to keep the existing employee base and executive base retained.
Yeah, because talk to us. I mean, you're someone who thinks a lot about, well, liquidity in the secondary market. And a lot of that, often these big valuations and moments of exit, which are currently the doors have shut to a certain extent, are because it's about talent management. It's about ensuring that they're able to take some money out, have a liquidity event. How hard has that become at the moment?
Well, for the best companies in this world, there's always going to be demand, right? So I think that that's something that we always measure when we evaluate companies, whether it's on a primary basis or on a secondary basis. And when it comes to Klarna, there's always been a really healthy volume of activity in the business, and investors are really excited about the prospects of where they're growing, because as of right now, they are the market leader across all geographies in the buy now, pay later space, and growing much further than just that nature of its business. And so I would say the prospects of the secondary market continue to get rather exciting and have created some really unique opportunities to buy into the business or dollar cost average across both businesses like Klarna and others.
What are you wanting to see from the leadership at Klarna, but the leadership of all your companies that you've currently been backing, and some that, of course, have seen exits themselves, but some that continue to grow in this environment? How do you want them to be focused more in on profit in this environment?
Absolutely. So I do say across the board that we're really focusing on seeing our companies invest in that profitability and increase their margins so that they can get above the line, right? And at least be in the single-digit profitability margins, where Klarna has sit for the last 14 years of its business, if not longer, right? So Klarna is an exceptional example of a company who knows how to increase its profitability and control it. Overall, though, for other businesses across our portfolio and others in the venture landscape, it's that we might want to turn down the dial a bit on sales and marketing spend and really increase that profit margin, which is really a level of just baking in those levers, right? Saying, hey, maybe we don't need to spend so much on Facebook ads or LinkedIn ads this quarter, or maybe, hey, we don't need to put as much money into creating a new layer of product roadmap, and instead just focus on the products that deliver, right? And focus on the customers who are there versus creating new innovative products just as a way to be unique in their product market fit direction.
How about products that had seemed a real winner in terms of, well, acquisition of new customers? Certainly, I think of Revolut, another European pinup in terms of, well, success story in the fintech world. And they really had doubled down on offering crypto, for example, to bring in new users. But with the fallout and valuation there as well, are you likely to see products moved away from, or do you think they'll remain committed to them?
I think that what they'll stop doing is just delivering on new products, right? I think as we look at companies like Klarna and like Revolut, is that they want to shift away from the core focus that they've been, honed in on. For Klarna, it's buy now, pay later, for example, and instead focus on creating volume from their existing user base, which is something we are really excited about, right? I think generally companies like Klarna realize where their public comps sit, and they want to ensure that they're creating their own market position away from those public comps and seeing that their growth can continue while just honing in on the products that have always been proven to be successful for these companies, right? And so I really love how Sebastian, the CEO of Klarna today, said on Twitter that what doesn't kill you make you stronger, because it's a business that I think generally understands exactly where their mindset could be to keep honing in on the products that win. And with this new capital infusion for Klarna, it's really going to allow them to keep that expansion growing across the United States, which is something where their public comp firm has predominantly had a dominant force, but Klarna, as we know, is just growing so much more faster at a 300%, annual growth rate relative to them as a comp. So we have a lot of hope there.
From your perspective, how long does this sort of quietening down in the private markets and valuations last for? And I'm not saying every business is affected by it. I think you're in Flexport, of course, which is a company that's, well, really ramping up because there's a supply chain disaster out there, and they're a company that can help. But there are areas like Instacart, which this is an inflationary environment. How long does that persist, do you think, Andrea?
Yeah, so I would say right now, we really need to see what the results of the first half of the year look like across all businesses, right? I think we're just closing the books on Q2 and going into Q3. And generally, where the reflection of the market is going to sit is what companies will be ready to go public, going into Q3, and ideally the months of September, October, and anything before the Thanksgiving holiday for the US companies. That's where I would see there might be a shift in sentiment. But what's happening is companies like Instacart, for example, are filing their registration statement. They're using really broad-based language to describe what kind of statement and company they're going to be as a public company and determine whether that's right to go out. So these companies are choosing when to go out based on where the market will be, but at least they're ready to do so if it opens up.
Andrea Wong, thank you so much for your time. Manhattan Ventures partners, stay well over there in Nashville. Meanwhile, coming up, an exclusive interview with the US Commerce Secretary, Gina Raimondo. Stay for it. This is Bloomberg. US Secretary of Commerce Gina Raimondo believes legislation that would appropriate $52 billion for domestic semiconductor manufacturing will pass Congress. She spoke exclusively on Bloomberg. Take a listen.
Yes, it will happen. It's taking much too long. And what's at stake is our national security, even beyond the economy. Every piece of military equipment requires chips. If you talk to the heads of national defense contractors, as I have done, or senior ranking officials in the Department of Defense, they're all very worried about the delay. But yes, it will get done. This is, at this point in the negotiation, unfortunately, politicians look for leverage. And while it isn't right to play politics with national security, that's what I think is happening. In the past 2 weeks, we made huge progress. We were closing out issues, finding compromise. So I think everyone just needs to come back today, get back to work, and commit themselves to getting it done in the next few weeks.
Let me ask you what difference it makes whether it gets done today or 6 months from today. What decisions are being made, perhaps by companies, such as, for example, the groundbreaking out in Columbus? What decisions are being made that may not be reversible down the road?
Well, what you say is exactly right. Chip companies are making decisions now, literally right now, because they need to meet demand of their biggest customers in 2025, 2026, which means they have to start getting cement in the ground on new facilities this summer and this fall. Earlier today, you saw Global Foundries has made a choice to expand in France, not the United States. That's a loss. You just mentioned Intel, who is saying perhaps they'll slow down their Ohio expansion in favor of Germany. And the reason is because these big companies are hearing from their customers that they need confidence that the companies will be able to hit the supply to them. 2025, 2026, 2027, chip demand is projected to be through the roof. And so these suppliers, whether it's Intel, Micron, Texas Instruments, they need to fulfill for their customers. They want to be in the US. But if the choices are not fulfilling their customer demand, or doing this in France, Germany, Singapore, Japan, who are already providing subsidies today, they're going to leave America and do that. And so that is the risk. And that's why today, members of Congress, get back into DC, get back, do your job, don't let America lose out.
Should we be expecting an announcement from the president before he departs for the Middle East this week on tariffs, on easing the tariffs that are currently applied to a number of Chinese goods? Because that, ahead of the CPI number Wednesday, will be something I think a lot of people would look for.
I'm not sure. I don't know, Guy, the precise timing. I can tell you that his team, are in active, discussions with him. It's something we're talking about every day. And he is, he's doing his job, which is to say, looking at all the different factors. You will see a decision, I think, very soon. Whether it's before he takes off this week, I'm not sure.
Just to pursue the China issue for a moment, Madam Secretary, the tariffs are one thing. That's one part of a much more complex mosaic here. We talk about tariffs in terms of inflation. You've already said that's not going to have that big an effect on that. But what about the larger term relationship with China? And let me be specific about this. In terms of specific tariffs being taken off or not, is it possible it could be bilateral? Is it possible China could actually give something to the United States to try to reformulate our trade relations?
Certainly that is possible. And you raise an excellent point, which is, part of the discussion. One of the things the president is thinking about, which is to say, if we're going to do this, what can they do on their side of the equation? So while I can't say for sure, certainly that is possible. And by the way, if it doesn't happen immediately, it's something that we will continue to pursue, just in the interest of, as you say, fairness. If we're lifting tariffs, what are they going to do?
US Commerce Secretary Gina Raimondo there with our own David Weston and Guy Johnson. Coming up, cuts. They are coming for the EV maker that's grown perhaps a bit too big, too quickly. We have more on the Bloomberg scoop on Rivian next. This is Bloomberg. This is Bloomberg Technology. I'm Caroline Hyde in for Emily Chang. Let's get to a Bloomberg scoop. EV maker Rivian was cutting its workforce by 5% after a hot growth streak, according to sources. Now, Rivian shares, they closed down 6.5% on Monday. And that, of course, was following the report from our one, Ed Ludlow. You helped break the story. Tell us a bit about where the job cuts are going to be coming from, Ed.
Yeah, so it's important to note that sources say these are non-manufacturing roles, right? These are not the men and women on the assembly lines actually building the EVs. They're kind of back office roles, supportive roles. And Rivian's one of these startups that raised a lot of money before going public, raised a lot of money when it went public, and they were just able to grow so quickly. They've kind of doubled headcount to 14,000 employees in the last year alone. And in some of those areas, kind of support ancillary areas, they just grew too fast, to too big a size. They have duplicates in a lot of roles. So with the macro picture such as it is, they're kind of trimming the fat and bracing for a sort of less solid global economy.
Overall, do you think that this is a case of having overhired? Is this a case of just reorientation? Is this a case of just trying to meet the economy where it is?
Rivian's interesting because it's supply constrained. In other words, the demand for their EVs is so great that they can't possibly keep up with it. They can't build the EVs fast enough. They do have a lot of cash, $17 billion on the balance sheet, but I get the sense from insiders, also investors, that $17 billion, a lot of it's already accounted for, right? They're going to build this second factory in Georgia to the tune of $5 billion. There's also all the R&D costs for the next generation of cars. And even though the CFO, Claire McDonough, is really inexperienced, she's a former Wall Street banker, she's very disciplined. And I get the sense that they're looking to preserve cash as best they can and kind of make it go a long way. So it's kind of all of the aforementioned things that you put.
Very briefly, of course, you were looking just last week at how Rivian was, well, getting snapped up at Sun Valley, at least in the photos.
Yeah, so RJ Scaringe, the CEO, was kind of the hot ticket. Everywhere I looked, RJ Scaringe was there and somebody wanted to talk to him. They brought some EVs with them, an R1S SUV and an R1T pickup to Sun Valley, and you had all these attendees kind of crowding around the car, look at it. But I'm told that on the Thursday night, Tim Cook, the CEO of Apple, actually borrowed one of the pickup trucks with a gang of people and went into town for dinner, which is interesting because as we've reported at Bloomberg, Apple's looking at its own EV potentially. And, you know, in the world of tech, it's interesting to see who's looking at who and who's spending time with who.
Indeed. What a small world it is over there.
Yeah.
Ed Ludlow, looking at everyone and what they're up to. We thank you so much, our EV expert there. And meanwhile, well, let's get back to it. The key story of the day is Twitter, and shares tumbled Monday after Elon Musk walked away, of course, on Friday from his $44 billion deal to buy the company, setting the scene for what is going to be a pretty disruptive legal battle. Our next guest says, well, Twitter is well positioned legally, believes perhaps Musk is looking for any excuse to get out of this deal. Joining us is Anne Lipton, Tulane University Associate Professor in Business Law and Associate Dean for Faculty Research. Wonderful, Anne, to have you with us and your expertise. And are there many legal grounds for Elon Musk to stand on here?
It doesn't appear like it. I mean, obviously, I don't know what I don't know. I don't know what facts he might develop as court proceedings continue. But at least based on what's been stated publicly, he's offered a number of grounds to argue that Twitter has breached its obligations and therefore he's entitled to walk away. And so far, they really just don't seem that substantial. So he claims that Twitter misled him about the spam on the platform. That's what's getting all the headlines. But he's not offered much evidence that it did mislead him. And even if it did, even if the spam counts were wrong, that's actually not a basis for walking away from a merger. He would have to show not only that they were wrong, but that they were dramatically wrong and were having some kind of long-term effect on Twitter's finances. And that kind of showing just, it hasn't been made. There's no evidence that that's the case. Yeah, so each one of his grounds, just they don't see that substantial.
Talk to us about the legal precedent here, because if they rule in Twitter's favor, what happens? I mean, can they really force someone to buy a company and then what occurs?
Well, that's exactly the issue. I mean, I think that most people, at least watching from the outside, think that Twitter is a very strong case. The question is what happens after Twitter is found correct? Then what? What do we do? Well, they've signed a contract, and the contract basically says that there are two possibilities. One possibility is specific performance, meaning Musk is ordered by the court to follow through with his obligations and actually acquire Twitter. And the other is that Musk pay a breakup fee of $1 billion. Obviously, Twitter would much rather he buy the company because he's promised to pay $44 billion, and that's bigger than $1 billion. So the question is whether a court can and will really order Musk to go through and buy the company. And Delaware has done that. There have been several occasions in the past where buyers got cold feet and they wanted to walk away, and a court said nope and ordered that they actually go through and buy. But this case is much bigger. It's a much bigger dollar figure on the deal, and it's a company that has this huge social footprint. And there's a real question as to whether a court will think it's appropriate to force an unwilling buyer to buy a company that's so important socially over his own objections. But then the alternative, at least contractually, is just $1 billion, which doesn't seem right either.
Yeah, and to that end, how much do the judges, the lawyers involved have to paint a picture of what has been lost for Twitter, financially as well? Because fundamentally, obviously, the picture has changed since he first made the offer, and we all understand that, and some would hypothesize that this is all just a way in which to renegotiate the terms of the deal rather than walk away entirely. But this is also, you know, they've lost key talent. How can you assign monetary value to that?
Well, that's exactly why parties contract to say there should be specific performance, meaning that Musk has to go through with it, because you can't put a dollar figure very easily on it. So that's why Twitter and Musk agreed originally that the proper remedy would be to order him to close, because there's no way exactly to put a dollar figure on it. And even if Twitter were to try, it would run into the fact that they've already agreed that if it has to be a dollar figure, $1 billion is the most they can get. So it's really kind of complicated whether the court is willing to order specific performance. If it's not, is it going to be stuck with the $1 billion cap, or will it actually try to assess the amount of damage to Twitter, which could be much higher?
And of course, I feel like this is going to go down in the history books, but also the legal education books of what we've now learned. We all knew this was from day one an extraordinary offer, an extraordinary deal, and a very extraordinary person at the top, sort of leading and driving this. From your perspective, does anything change? Do you think this makes companies act in a different way when they have become a target?
Well, Elon Musk is so singular. I mean, nothing about this deal unfolded the way deals normally do. This sort of overnight purchase where he was pressuring the company on Twitter and it was signed almost immediately. I mean, if there's any lesson here, it's that if you have sort of an erratic buyer, to be a little bit more careful, at least in the drafting of the merger agreement, which is otherwise very tightly drafted. But I mean, the $1 billion damages cap, maybe they shouldn't have included that part. But I'm not sure how many lessons there are for the future, because I'm not sure how many impulsive buys of a $44 billion of a public company you ordinarily see. I mean, it's the oddity of the purchase and the impression that Musk gave that he was buying it not for financial reasons, but simply because he wanted it personally, that make this so extraordinary and so hard to figure out what the next steps are.
And of course, everyone quips, oh, the only winners are the lawyers. Are they?
Well, they'll certainly do pretty well. I think Musk will pretty much win if he gets to walk away from this for $1 billion and nothing more. I mean, because he signed an agreement and created this chaos for this company. And if the only thing he has to pay, I mean, for me, $1 billion would be quite a bit, but for Elon Musk, it's what's under his couch cushion. So, he, I think, would make out pretty well if that's all that he had to pay. Otherwise, he ends up with a company.
Ann Lipton, extraordinary times. You put it all so eloquently for us. We thank you. Tulane University Associate Professor in Business Law and Associate Dean for Faculty Research. We thank her for joining. Coming up, crypto, well, it could be facing another tumble, but does this actually mean that the regulation for digital assets is more important than ever? Kristen Smith, Blockchain Association, with us. This is Bloomberg. Let's talk about today's crypto report. Wall Street, some of them, are expecting the crypto crash to get a whole lot worse. Now, Bitcoin is likely to drop to $10,000. That's according to about 60% of a mixture of Wall Street and retail investors who responded to the latest Bloomberg MLive Pulse survey. Joining us now to debate and also where next for policymaking is Kristen Smith, Executive Director of Blockchain Association. I'm pleased to say, as always, it's Shonali Basak as well from Bloomberg. And Kristen, I want to get your take first and foremost. When we can take what we want with a pinch of salt to a certain degree of where next for prices, but as we see this unarguable crypto winter upon us, is it now the time to be doubling down on policy making, ensuring that perhaps the protection's there as and when maybe we get a more intense bout of interest in the space again?
No, I think you're absolutely right. There's a big focus right now in Washington on trying to figure out the right regulatory framework for cryptocurrencies. It's important to remember that there are a lot of policies in place today. The on-ramps and off-ramps are regulated for anti-money laundering purposes. There's sanctions requirements. There's securities laws that apply in certain instances. But what we really need is a fresh look at the regulatory space. We need to figure out a framework for stablecoins. We need to figure out a framework for regulating the spot markets. And I think the events that have happened in the market in the past few weeks and months have really focused policymaker attention on trying to figure out a path forward.
A path forward, and especially as you look at who has claim to the assets at the end of the day in the event of bankruptcies or other forms of unwinding. How do regulators start to make sure that it is indeed the consumers that are protected instead of the investors in these companies? And what types of tensions does that create moving forward?
Well, listen, I think this is the first time we've seen a couple of the larger companies in this space go bankrupt where there's actually questions about customer assets. So I think that there are some places in bankruptcy law that we need to look at this. I think more importantly, though, we need to have a regulatory home for these types of these types of entities that are doing consumer lending. We have not seen in the past very many crypto native organizations be able to get bank charters. I think we need to have a discussion about how can we open it up so that when you're dealing with customer deposits, that there is some sort of regulatory framework in place.
You know, you're really tied in with both the regulators, the lawmakers, and the companies themselves. Realistically, we've been waiting years, and there's been very little movement on that front. So realistically, how soon can you see it now that you're seeing customers, retail investors lose hundreds of millions of dollars?
Well, I think if you look at kind of the overall timeline, the key moment for getting this done is going to be 2023. I think that most regulators have done everything they can within the authority that they already have to provide guidance in this space. Not all of them, but most of them. But what the sort of consensus is we really need a new framework, one that Congress has to put into law via legislation. And we've been very excited to see proposals like the Lemus-Gillibrand proposal and others that are trying to look at these questions in a thoughtful and comprehensive way. I think the political reality is we're not going to see very much traction this year because the election is coming up. There's only a few legislative weeks left. It's something of this magnitude just simply isn't going to move. But what we're doing at the Blockchain Association is with our members are meeting every single week to go deep on a different topic and finally sort of coalesce around what we think we can live with as an industry and so that we can come to the table with solutions. So I think there's a lot of work, a lot of discussion, definitely a lot of legal bills, I can tell you that much. And we're really working hard to try to bring actionable solutions to the table. And I think 2023 is going to be the year that this all comes together.
What about other jurisdictions? Is Europe leading the way in some way? Are there other regional driving forces that are leading the pack versus the US?
Yeah, no, Europe made quite a bit of, I guess you could call it progress. Last month, they passed a sort of a more comprehensive look that impacts legislation that looks at both stablecoins as well as spot markets and things of that nature. I don't think the way that they've landed on their policies are ideal, but they have moved forward. And I think that's another factor that will put more pressure on the U.S. Congress in order for them to move forward with a more comprehensive legislative solution.
How hard is it for regulators to really either make customers whole or keep track of client funds when so many companies are deciding to domicile elsewhere? Dubai is becoming a huge hub for crypto firms, Hong Kong, the Bahamas even. So how then do customers in the U.S. stay protected?
Well, customers in the U.S. should be operating with U.S.-based entities that are licensed to operate here in the U.S. There is technology where you can get around any sort of geofencing that's put into place. And we've seen quite a bit of this actually in the derivatives market because there is demand in the US for more access to derivatives. And the only way to get around that is to use a VPN and go to some overseas exchange. So I think actually having better, clearer rules of the road here in the US will keep consumers protected here and make sure that the companies here in the US that are offering these services have the ability to meet the demand that their customers, the services that they want, and do that in a way that's much, much safer.
Kristen, have you been discussing with companies sort of their moral obligations going forward as well? They might not be legal obligations, but many will say, look, this push towards saying it was democratization, this fervor around this FOMO feeling around advertising, particularly at the peak when we're all looking at, adverts that happen to be around the Super Bowl. Have there been lessons learned there? And is there an element of self-regulation going forward that they don't get themselves into this sort of situation again where, yes, you can read the small print, but really they should have been more transparent that there isn't FDIC protection and the like?
Yeah, no, it's interesting. It's the DeFi protocols itself, the true decentralized finance. that didn't break. And even with vast changes in prices and a tremendous amount of market activity going on, the DeFi protocols themselves, they continued to operate, right? That's just software. Where we've run into trouble is situations where we have centralized entities that are taking possession of other funds, and also where we've had lending that's gone on in a way that's levered, multiple times over. That's really been where the problems have been. And so I think that what we have to do is look at how do we put regulation on those centralized entities, and what are their obligations. But the underlying technology, these software-driven DeFi platforms, those continue to work just fine. And in fact, even under a tremendous amount of stress, they all continue to perform. One other thing I would point out, though, is that the industry itself is swooping in to make sure that customers are harmed as little as possible. We've seen Sam Bankman-Fried at FTX, who's come in and been a backstop to many of these companies. I mean, I've been joking, we don't need Uncle Sam because we have Uncle Sam Bankman-Fried. That is obviously not sustainable, but it's very much, sort of like JP Morgan back, in 1907, saying, hey, we see the bigger picture and we want to get through this turbulent time so we can get on building all of the services that we think are going to improve so many lives.
We thank you so much, Kristen Smith of Blockchain Association, along, of course, with our own Shonali Basak on all things crypto. Meanwhile, let's get some breaking news because it was one of the biggest SPACs, of course, special purpose acquisition companies, Tontine Holdings. It was, of course, Bill Ackman's Pershing Square Tontine Holdings. It's going to return that $4 billion of money it raised, a capital, to shareholders. The CEO, Bill Ackman, is telling us in a letter to its shareholders at the moment. And, of course, this is after they failed to find an acquisition to take out. So the clock is ticking for many of these SPACs, and many of them still without an acquisition in the field. We'll have much more on that, but later we also want to talk a little bit about Prime. Is it, past its prime with inflation persisting, or will Amazon's big day be the #1 event as it always is? We discuss. This is Bloomberg. Amazon Prime Day. It's this week, which means the internet was going to be a frenzy over limited time deals and exclusive Prime member-only prices. Joining us now on what to expect, Spencer Soper, who covers Amazon. And of course, it's a difficult time. Inflation is real. Is it going to be more expensive? Will you still going to be able to get the deals that we used to?
Yeah, it's a great question. You have this conflict, right? So you have, it should be a great day for a sale because so many shoppers are trying to fight inflation by looking for deals. But then, merchants and brands and manufacturers, they're all dealing with rising costs as well. So they don't want to offer steep discounts because they want to be wary of the profit margins. So it's going to attract a lot of people. They're going to spend a lot of money. E-marketers estimating up about 17%, but they're probably not going to get as much with their money as they'd like to.
Yeah, we're all sort of used to that. We're spending the same amount, but we're getting less and less with it. To that end, how much are they managing to bring people in more into the actual Prime overall offering? They've obviously been doing some interesting offerings, but purchasing, Grubhub was the latest one that we understand they're going to be teaming with. How much are people committed to this?
That's a really great question, and we're definitely seeing signs that Amazon's finally hitting a ceiling in the U.S. on Prime membership. There are some numbers that came out last week that there are about 172 million Prime members. So that could include multiple people under one subscription in a household. But 172 million members in the U.S. as of June 30, which is unchanged from January. Now, granted, they added 30 million in 2020 and 30 million in 2021, so they saw this huge leap during the pandemic. But there's definitely signs that it's leveling off, and we'll see if it starts fading if people start looking to cut their budgets in the face of inflation.
Yeah, just to that end, do you think Amazon is prepping itself basically to become even more necessary in this time of inflationary pressure, or is it a subscription that we're all more likely to cut?
Well, they definitely want to be absolutely necessary, and that's why they keep building things in on it, like video and that sort of thing, so that as you're looking at your budget, you'll think, well, do we really need Amazon Prime for the delivery? But you know what, we watch the video too, or we get these other perks as well. Now they threw in Grubhub, like you mentioned. They're just trying to pile things on to make it, as compelling as possible, as people are looking to cut things out of their budget. But granted, they just raised it by $20, $139 a year. Some people might be thinking it's time to cut Amazon loose.
Oh. We all keep reflecting on our budgets and seeing what's the most integral. It kind of depends on the programming as well, I'm sure. Bloomberg's Spencer Soper going to be bringing us, well, what the hottest deal is. Apparently, according to my producer, it's makeup brushes, lotion with collagen. Who knew? That does it for this edition of Bloomberg Technology. Tomorrow, an exclusive with Jess Lee, partner at Sequoia Capital. Her advice to founders on how to navigate the current market conditions. You do not want to miss it. And don't forget to check out our podcast. You can find it on the terminal, as well as online on Apple, Spotify, and iHeart. From New York, this is Bloomberg.